And I welcome all of you all back to APEX 2023. We are going to start with the third panel discussion of this afternoon. I hope all of you all are nicely energized, settled. I see smiling faces over there. Food always does that to us. So with all of that energy and positivity, I think we are good to begin with the third panel discussion. Like I've told all of you all, we are going to focus on private equity. So over here, we are going to focus on what 2023 looks like when it comes to private equity. And in this panel, let me please welcome on stage our esteemed panelists. Ladies and gentlemen, can we have a huge round of applause for all of them? Upasana Rao, partner Trilegal. Mukesh Mehta, senior managing director Blackstone. Manish Kejriwal, managing partner and founder Kedaara Capital. Anjana Sasidharan, partner Catterton. Manish Gaur, managing director, Multiples Alternate Asset Management. Bhavi Ajmera, Senior Investment Officer, IFC. Can we have a huge round of applause for all of our panelists? No, I am going to start with that kind of an applause. All of us have had a lot of good food and a lot of conversation. That's the spirit. So very quickly, I'm going to introduce to all of you all your moderator for this discussion. Upasana Rao is a partner in the corporate practice at Trilegal with a focus on mergers and acquisitions, private equity, venture capital, and corporate restructuring. Her transactional experience includes a number of share and asset acquisitions, debt and equity investments, joint ventures, and distressed assets acquisition. She regularly advises on regulatory matters, corporate governance, and conflict management in investments. She has advised on transactions across various sectors, including energy and infrastructure, alternate real estate, such as data centers, financial services, retail and logistics, as well as venture capital and private equity in SaaS and technology startups, including mobility, e-commerce, healthcare, and financial services. Now, if I go on talking about her, the list is endless and it is already making her blush a lot. So without much further ado, can we have a huge round of applause for Upasana and the entire panel, please? I hand it over to you now.
Thank you. Good afternoon. Can you hear me? Okay, great. So thank you for attending this panel discussion with us where we are going to focus on private equity. You've already heard about my introduction, but it is my pleasure to moderate this panel with esteemed panel speakers, and let me introduce them. This is Mukesh Mehta, Senior Managing Director, Blackstone, Manish Kejriwal, Co-CEO and Managing Partner, Kedaara Capital. We have Anjana Sasidharan, partner at Catterton. We have Manish Gaur, Managing Director, Multiples Alternate Asset Management, and Bhavi Ajmera, Senior Investment Officer, IFC. Welcome to all. I would request you to please introduce yourselves a little bit. I'll just go around the panel with the opening questions. So starting with investment outlook for 2023 and looking back at the last few years. The last few years have shown some very interesting trends for private equity, with 2020 being slow, cautious because of the pandemic, and then 2021, of course, being a record-breaking year for private equity. High volume investments as well as high value exits, and then a modest decline in 2022. So overall in 2022, I believe the private equity investment value fell by almost 29 to 30%, which is still the second highest in all times. So opening question to all panelists is about your investment mantra for the coming times. And maybe I'll start with Mukesh. Mukesh, from the lens of a global private equity firm like Blackstone, can you step back and take a longer term view, how you have seen the development of the private equity industry so far, and what is your current outlook?
Well, thanks Upasana. I hope everyone can hear me. So just before I go to this question, I would like to briefly introduce my firm, Blackstone Group. We are the world's largest private equity firm with a market cap of $120 billion and close to $1 trillion of assets under management. In India, we have around $50 billion of assets under management. Just to give you a context of these numbers, if you take this AUM, we'll be the top 10 business house in India. And in terms of our approach is always a business builder approach, a strategic buyer approach versus an investor approach. We get into things where we really think we can add value by working with a strong operating network of advisors and getting synergies across our portfolio companies. So that's Blackstone for you. And coming back to your question, Upasana, on how I've seen at least been in this industry for last 17 years. And I remember I started as an analyst 2006, exactly 17 years back. And it was quite funny at that point, majority of the investment were private investment and public enterprise. We used to pay premium to get 5 to 10% of a block. It was said, I'm sure Manish will agree to that, that even to get 5 or 10% of a public listed company, you have to pay premium. And since then, fast forward it, 16 years or 17 years down the line, the market has really matured. The size of the industries have increased by almost 7x to almost $70 billion annually. Not just the size of the industry, but also the type of the transactions. 50% of the transactions now greater than $100 million are buyout transactions. So the industry has shifted from just stock picker to actually being a strategic builder of business. So 50% of the transactions are today buyout. Around 80% of the transactions are now moving towards more than $100 million. Even the size of the transactions are increasing. So I think the industry is matured and there's more to go in terms of the way we have started from just being a minority investor to now being a control-oriented investor. So that's first thing. And in any industry, the success is actually not determined by the investments, is determined by the exits. And we've seen that India, the exits also has increased five times, peak being $36 billion. And that has really given the confidence to the LPs to invest more in India. And, I think the industry has moved a long way over the last 16 years. And in terms of current outlook, we continue to remain very, very bullish in India. In terms of our own performance, for Blackstone globally, India is the best performing geography in private equity for the last 5 years in a row. So we see a lot of returns and still there's a lot of room to capture and a lot of growth left in this country. And we're very, very bullish on India.
That's a great start to our conversation. So moving to Manish. Manish, from your experience across many cycles, what do you think if there is any difference in the current cycle? And no. I'm looking at you. So what do you think is different, if there is any difference in this current cycle? And how do you think that corporate India can emerge stronger in the current global environment?
Sure. As you said, first a bit about myself and the firm. I used to be a lifer at McKinsey for about 7, 8, 9 years across New York, London, Bombay. I then started the first office for Temasek outside of Singapore, which was India. Actually, we started in India before China. And we deployed at that time about $7 or $8 billion in India in both public and private markets. And then taking off from Mukesh left off around 2010 or 11, as he described, private equity there were three issues. Valuations were extremely high. I don't believe most PE firms were adding any value at all because you were left with 4, 5, or 6% stakes. And the third issue was you had no exits. You were beholden to the family to do an IPO, and if they decided not to, you were stuck. So the entire way we actually formed Kedaara Capital, which is what I represent right now, is a firm which tried to knock at those three and resolve those three issues. And the very first thing we did was we said, we've got to have the ability to both control and minority deals. We formed a partnership with a leading US firm, which is the next building is Blackstone in New York, called Clayton, Dubilier and Rice. They are much smaller than Blackstone. I get scared by the numbers Mukesh throws around, and we are a little fly on the wall. But we raised our first fund, very proud to say, in 2012. Our maiden fund was about $570 million, just to give you a sense. Our investments we primarily did were old world, smokestack industries. You know, we paid, again, from a valuation perspective in each of those. I don't think we had any deal which was more than, they were all in single digit EV/EBITDAs, very different from what we're doing right now. That fund had 9 investments. We've exited 7. We've had a DPI of more than 2.5, and it's an MOIC, dollar terms about 4.1. So we've done well. That led us to Fund 2 in 2017, which was about 800 million, and then we raised a fund, another fund 2 years ago, which was Fund 3, Kedaara 3, which was 1.1. We only do classic private equity focused only on India, but we do both minority and control. We have a bunch of very strong operating partners, which are part-time people like Pramod Bhasin, like Sanjeev Aga, who really help us in, especially in the companies that we have a controlling stake in, and Neeraj Swarup. But we also do minority stakes. We've taken a less than 10% stake in a firm called Manyavar, which you all know. And I will say upfront that, you know, people take pride in being control and not minority. If I was to do a regression between minority and control deals, or even the percentage of ownership we had in every company and a scatter diagram on the x-axis and the y-axis, the IRR, there'd be absolutely no correlation, be all over the place. So the fundamental issue which hasn't changed is finding the right team, and the right team, right? So that for us, the beauty on India, and the reason many of us have had the opportunity to go overseas and work overseas would much rather be in India, is the quality of the entrepreneur and some of the business families is absolutely amazing. And I think to Upasana's question, I think the next decade is absolutely India's decade. And, you know, people who've seen the cycle since 2000, I mean, I think if you have the cycle and you entered the industry 2 years ago, you think the world has ended, right? I would just say, I think there can't be a better time for investing because the fundamentals are as strong as ever. We have a situation where some of the large capital providers, we won't take individual names, but large pools of capital which did a lot of tech and high-tech deals, which you might have called a fund, the media calls it funding winter or whatever. From our perspective, we're finally relevant again because our perspective on valuations hasn't changed. The market might have changed. The issue was in 2021, every bid we put on the table was, we were thrown out of the room. We were the first to be kicked out of the room. They had exactly the same valuations because we don't want to play around. We think there's a fundamental value for every company. We may be right or wrong. We've been brought back to the table. In some of the very same deals which we had been pushed out of the room, we've now come back to relook at them at a number which is much closer to ours. And I think you know, of course, are there going to be events like Adani? Of course there will, but I think the situation here is the underlying, to your question on the future of the family, even in Adani, the thing is the underlying businesses are absolutely fundamentally strong. They're generating great cash flows. They've never defaulted on a company. Would we invest? I don't know, but I'm just saying it's not a scary thing, and to the point that some foreign investors have run away because of that. It's a better option for the rest of us who believe in a long in India. I'll stop there. I could go on and on.
It requires 2 extra hours, which you don't have, unfortunately. But moving to Anjana, we have such seasoned practitioners here. So Anjana, you've spent time with Sequoia, now with Catterton. What is your outlook for this year? Are you going to be cautious? Are you going to be aggressive? Minority investments, control, that's not usually what you have been doing in the past, but particularly in the context of the consumer sector where your focus is.
Thank you. First, let me introduce myself. I'm Anjana Sasidharan. I'm a partner at Catterton, and I lead our India investment business for our Asia fund. Prior to this, I was at Sequoia for about a decade, and just like Manish, was at McKinsey, but for a few years fewer.
So she's much smarter than I am. You leave McKinsey earlier.
Correct, I didn't take too long to figure out. To tell you a little bit about the fund, Catterton is one of the leading consumer-focused private equity firms globally with about 32 billion under management. We currently invest in Asia from our, invest in India from our Asia franchise, which is the third fund that we're currently deploying. Looking to invest in high-quality B2C companies across traditional businesses as well as consumer tech businesses, with check sizes ranging from 25 million going all the way up to 150. We've made a couple of investments in India in the last couple of years. One is Sugar Cosmetics, and the other was Geo. We were the fly on the wall in that very big round, even though it was the largest check for us. And we recently sold days to Lenskart, which is also a Kedaara portfolio company from the Asia Fund. So very, very keen on making sure that India works. From our perspective, India is the largest high-growth economy globally. And therefore, we have no way but to take India seriously. And this is a market where 70% of GDP is driven by consumption. There are three trends that we at least are quite focused on. One, I think, in this room, everybody is well aware of the shift of the demographic in our country. We are going to be the world's most populous. 52% of our population is going to be Gen Z and millennial, and it's going to stay that way until 2030. So I think all of us, including us, are too old, too wealthy, and too metro to represent India truly. And therefore, we try our best to keep our ears to the ground on what's happening with the Indian consumer. And that's a muscle that we sort of bring in terms of just staying close to consumer insights across multiple markets. In addition, one of the things that truly differentiate India is the access that has been created to this population. We are way behind on physical infrastructure, and our government is doing a bunch of different things to fix that. But on digital infrastructure, we are actually way ahead of many markets. We all know that there are 500 million people online, there are 100 million transacting users, but what we fail to realize is that we are starting to become very relevant in the global scheme of things on the share that we represent, right? 21% of mobile data is consumed by India because we are the cheapest. Our per capita consumption of data is the highest in the world on mobile. And as a result, reaching this young millennial consumer while they're, I'm told, doom scrolling, has become much easier for all brands that are now trying to reach them. That combined with UPI, which I believe now represents close to 30% of global daily financial transactions online, start making this a very powerful market in terms of what the future represents for all of us, collectively as investors in this ecosystem. So we are also very optimistic about what this represents, even if there are near-term challenges around inflation and recovery, which we do believe there might be some concerns around, but long-term very optimistic. And finally, I would say that in addition to the trends on young consumer and access improving, just the consumer behavior change as this young demographic starts spending is materially different from the way people think about life today. I keep joking with my colleagues about the shoes people wear in office. The most expensive shoes actually belong to the analysts and the associates already. So as this cohort goes from being 25 to 30, the way they spend on categories like travel, on living in the moment, on experiences, on shopping in each and every subcategory will actually change quite a bit. And we see all of these as very powerful trends that will lead to business building for consumers. So we are very risk-on as far as India is concerned and believe that we have many years of secular growth ahead.
Absolutely. I think I see a lot of heads nodding here. So Manish, to you, Multiples also has a diversified portfolio, and what is your investment outlook, and what are the macro factors that you will be keeping in mind, as well as market factors that you will be keeping in mind in the coming months?
Sure. So maybe I'll just take a minute to introduce myself and my firm as well. So Multiples, as you know, is one of the larger homegrown domestic private equity fund. We are right now in our fund 3. We have gone through 2 full fund cycles. and have delivered excellent returns on both funds. And I think we will be in the market to raise our fund 4 pretty soon. Across the funds manage about $1.8 billion of assets, including some of our LP assets. And unlike Mukesh or Anjana, we are completely focused only on India. So we live, breathe India only. We have no choice but to invest in India, and we happily do so. Personally, I have spent about 18 years in private equity, and that around 5 years on the sell side research. I started actually 1 year earlier than Mukesh, right next to the room that he also started. Have seen a few cycles. I think to your question on the investment environment, I think we at Multiples, we have a cadence of doing maybe 3 to 4 transactions a year across sectors. And I see no reason why that should change this year, right? I think, of course, there are some pockets of landscape, like say, a few consumer tech businesses or SaaS businesses, which had seen a lot of froth in 2021 because of the way easy liquidity was driving up valuations, and that seems to have come down. But even in those sectors, I think companies which are doing well, whose operating parameters are improving, we see them accreting enterprise value and are able to raise more money from very discerning investors. Outside of that, I think there's a lot of news flow about interest rates or currency depreciation. I think all of those issues for a long-term investor really doesn't move the needle. I think we continue to focus on finding high-quality businesses managed by high-quality teams. And that's really the struggle every single day, that find the next deal which really meets those parameters. Not too much worry about things which are uncontrollable and honestly unknowable, like interest rates or currency rates, et cetera, et cetera. So I think we want to maintain our cadence of putting more money into the country across the sectors of our choice.
Thanks, Manish. And Bhavi, I recently learned a lot of banking experience as well, and now with IFC, your particular focus is on some very key core sectors for the Indian economy, like manufacturing and services. So these are diverse but core to the Indian economy. What is your outlook as to how these particular subsectors may be impacted because of the current environment?
So first of all, good afternoon to everyone. Just a brief background about myself. I'm Bhavi, Ajmera. And I'm very recently into the private equity sector. I used to be a banker, an investment banker, focusing on mergers and acquisitions for 16 years, and I more recently have joined IFC. IFC is part of the World Bank Group, which focuses on development of economies. It's the private side investment of the World Bank Group. So World Bank Group would invest into government projects, while IFC would focus on development through investment in the private sector. So that's the focus. IFC, I'm sure all would know, has been in the country for about 50 years. I think it's even much more. I mean, we're one of the early investors in the country, and even till date, it would be one of our largest portfolios. We do invest in over 100 countries, but India would be still one of our largest portfolios, right? So that's for me. And in terms of the manufacturing and the agri and services sector, I see the way IFC basically looks at investments is, looking at 4 core segments and then, cross-cutting across segments through the lens of ESG, which is core in our DNA. Manish. And yeah, so it's very important for us to focus on ESG, and that's core to our DNA. But the 4 segments that we think that we can participate in any country's growth is financial services, through the manufacturing sector, to the infrastructure, and obviously even to deploy much more, we do invest through funds as well. And one of our success stories in investments has been in multiples as well, right? So that's just a background of IFC and what we do. What we see specifically in the manufacturing and the services sector that I focus on, we just believe that there is a significant runway. Unlike what has happened over the last couple of years, most of the companies have focused on deleveraging and hence, and has done a lot of capital raise, alongside with, some CapEx investments. I mean, balance sheets are very, very robust. That overlaying with, I personally think it's a fantastic policy, well thought through policy changes that have happened, which the government is, enabling private sector to participate in profits as well through the PLI scheme. We believe that overlay will, result in a strong inflection in the CapEx story, and, one can potentially participate quite significantly. And from a demand side, obviously, India is likely to be the next factory for the world. So from that perspective, the whole export-oriented market is going to be something which we believe there is a strong potential from our perspective as well. And not to take away, as mentioned, that the demographic dividend is still fully intact, right? So both the domestic play alongside with the export-oriented that we can have, I think that's a robust story for the next 10, 12 years. And at least personally, we believe that, the contribution of manufacturing to the GDP, which is currently anywhere between 15 to 16%, could, over the next 5 to 7 years, could go up to, in a growing economy, to anywhere between 20 to 20%.
So all positive outlooks, but looking back at 2022, we saw one big observation, which was valuation corrections, right? And equity markets across the world are seeing sharp corrections, particularly in certain types of stocks like technology stocks. So maybe Mukesh, I'll start with you again. Do you think that today's situation marks the end of high valuations and we are coming down to now more realistic valuations, or am I simplifying this far too much? Do you think that private equity investors are going to be more selective given the high cost of capital?
Yeah. Before I answer that question, I was in a LP meeting yesterday, and it was a stark revelation to me as well. And we were talking about market correction in India, etc. And he threw two stats at me. First is last 5 years, MSCI India index has given 9.9% dollar returns for the last 25 years. And guess what it is for US? It is 7.2%, and for China it is 5%. Oh. So irrespective of whatever chaos, whatever issues we talk about India, in dollar terms, India has outperformed both US and China, irrespective of whatever issues we have, tremendously. And that gives me really that bullish, why we are bullish about India is exactly because of this reason. Because irrespective of whatever issues we have, whether we have demonetization, whether we have GST, whether we have DHFL crisis, India emerges stronger every time. Now, coming back to valuations, yeah, definitely the mid-cap index in India has corrected almost 20% from its all-time high, and it's almost close to its 10-year average price-earning multiple. So, valuations have corrected to realistic level, and our industry as such is not a straight-line industry. It is a cyclical industry. We deployed almost close to we committed 5 billion capital in India in 2021, which was more than what we did in last 10 years combined, and last year was almost 1/10 of it. So I think next 6 to 12 months will be very attractive for India, especially for the private equity setup, as valuations have corrected in public market, and even the primary market is almost shut, which makes private equity capital even more attractive. And but we generally have seen that private equity industry lags the public market industry by almost 6 to 12 months, because it takes time for the private market to really get to the valuation levels. So I think next 12 to 18 months, but maybe towards the second half of this year, it will be an extremely attractive setup. I think we'll not be thrown out on the first bids. And people who generally add value will be considered. And last thing I want to say is, for us, especially for Blackstone, we always believed, and I say it with a lot of confidence, for us, it's not whether paying 5% lower or 5% higher makes sense. we are not good stock pickers. We have burnt our fingers in 2006 being smart investors, buying stock low, selling high. But what we really realized is most of the returns for us have been through by driving value creation, by changing the trajectory of the company, by getting revenue from our portfolio companies. And I think in the long term, that survives. And we are really very, very bullish about India.
Manish, you commented just before we came here that the success of a fund is defined by the exit, right? So on that point, again, 2021 bumper year, public IPOs and backed by PE funds, right? But 2022, sharp decline. Again, do you think there has been a change in how you see public markets as the exit opportunity for private equity funds, and does that put pressure on finding, strategics or secondary buyouts as the alternate?
Upasana, great question. And of course, again, if you've seen the cycles, you'll always, what ends up happening, if you step back for a second, is actually as private equity, the other side of the coin is you actually end up competing not with each other, but with public markets. So often when you're looking to go to someone for funding, and we've had discussions for a long period of time, don't think of a strong, buoyant market as an opportunity to exit into an IPO. When you're looking at new companies, often with a minority position, a very buoyant public market actually is a chance for the promoter to actually list his company at what could look like crazy valuations in 21 instead of coming to private equity. So all I'm saying, it goes both ways. So now to answer, actually a very buoyant market competes with you when you're trying to deploy your capital, right? So that's point one. To your specific question on exits, of course, it's going to be a significant dampener. But I think it's also, I believe, at least as far as Kedaara is concerned, I think many on this panel agree, the sort of stuff going through the markets and at the valuations was completely unsustainable. So you could almost take a crappy company and add words like digital and transformational and strategic and all the other buzzwords we've learned, and the IPO would happen. I mean, it almost seemed that way. Of course, it's much more complicated than that. I think that opportunity is gone, right? But I think as any of us on this thing is when you enter a company, and we did this, as I said at the very beginning in 2011 itself, where at that time the IPO markets were probably, if not the only, I would say, I don't know the real numbers, but maybe 70 or 80% of your exits were driven by IPOs. And in our first fund, actually, our 9 companies, we took 6 companies to IPO. In fact, we are known as the firm. People have come to us since then and saying, help us, IPO. We said, yes, but we also want to take a stake in your company. We're not a banker. We will help you do that. But at the very get-go, we were really focused on the other types of exits, which were through strategic sales, either to global or local strategics, or now one of the most buoyant markets is among sponsors themselves. So we've had at least 3 companies we've sold to other private equity firms. Warburg was one, Advent was another. We tried to sell to the Blackstone guys, but they're too smart to buy from us. But no, seriously, that's the sponsor-to-sponsor thing. And it's actually a very real market. People will see value in a certain stage of growth. One firm, another firm will. So I think it's actually very productive. So I think when you, as a private equity investor, especially if you have a controlling stake, in India, a controlling stake in IPO is not the ideal exit, because then your ability to get out, when you're seen as a promoter or a key person, gets, depending on which sector it's in and depending on the regulator, you can't then get out of the rest of your stock holding, right? So in that, both the strategic sales to global and local strategic and sponsors extremely important. I think the market has really evolved and is far more mature. And finally, what you're seeing in the last 1 year, maybe last 2 years, it was a global trend 4 or 5 years ago, is something called a continuation fund. So if you saw Samara, they did a very, I think they did an excellent job when the markets were down, the IPO markets were closed, and they did what's called a, I don't want to go into the details of that, but that's another very positive development in terms of an exit where if you have 2 or 3 assets left in the flag end of a fund, and the IPO markets are down, instead of just selling it at distressed or low valuations, you have a chance to sell it to what is called a continuation fund, and as the name implies, you get another set of investors, and your eventual exit is based on the intrinsic value of the company. So I think the good thing, in summary, is as PE investors, you've got to be ready for both buoyant and not as buoyant markets. In a buoyant market, you have great chances to exit, but then it's a tougher market to enter. And in times like this, I think you've got to be a lot creative on your exit options. But the good thing is even a market as evolving as India has become in the last few years ripe for many other exit opportunities. So I don't think the IPO, which was the only source of exit 10 years, 15 years ago, is one of many.
Absolutely. So intrinsic value being maintained is, good for all kinds of market exits, private, public. And coming to you then, Anjana, from your point of view, like you mentioned the attractiveness of the consumer sector, but it also, and it's also propelled by digitalization and e-commerce supporting it. But it also is a sector where there could be a lot of cash burn. So, from your perspective as a consumer-focused investment firm, how do you select, value-creating businesses? Yeah, that's my question.
I guess this has been much debated, and I feel like, Upasana, you've been party to some of my lunchroom conversations. But anyway, see, from our perspective, as private equity investors and not from a VC or growth stage, good consumer companies actually don't need money. So that's the reality of a high quality consumer brands business, right? Now, the sentiment of saying that consumer is expensive has come from the spending that we have done as investors, board members, shareholders of various companies, has come on the back of marketing becoming very expensive and growth being driven at all costs, right? So I would say that we are now in a time where we've moved from that narrative back to asking questions around what truly matters in a business. This has been actually a hard 1 year for us because through 2021, similar to what Manish said, we evaluated probably every consumer company there was, every consumer tech company there was, landed at a price that was anything between 30% and 70% of what the company's ask was, right? And actually didn't deploy into a single company through 21. I'm very glad for it right now, right? A few, because in some of these cases, companies that have showed up capital now have the time to cut flab and fix their business models. But in some other cases, companies are now having to deal with the reality of having spent that money and dealing with down rounds. But if you peel the onion a little bit, it's basically a question of, have you found product market fit? Have you really thought about what gross margin is today versus long term? Have you thought about how distribution rollout is going to play out? And for all the excitement around omnichannel, marketplaces tend to behave like wholesale in a very rudimentary term. Offline, you actually have no advantage relative to incumbents. And truly D2C, which is going after your customer via Facebook and Google, is getting more expensive by the day. So I think for companies who are trying to be omnichannel, it's very important to be able to balance out their spends and their brand building in a way that it still makes economic sense. I think we sort of took a step back and said, it's okay, then we'll figure it out. We'll lay the rails as the company is growing. And overall, it's resulted in a few casualties. To be fair, these are cycles that I would say all of us have seen. I would imagine this is like the 2006-07 infra wave. Then I remember while I was at Sequoia, there was the Uber for everything wave. There was the O2O wave. These keep coming. And I would say between 21 and early part of 22, there was the D2C wave. And it's very hard to sit on your hands and say that we will wait for this to pass. But these things are cycles in an investing environment. You keep seeing these, and there will be cycles where companies bulk up, and there will be cycles where they will cut flab. So I just see this as a cycle where people have to cut flab. But fundamental business quality in consumer should not require capital beyond a point. In fact, I would argue that for private equity investors, that actually makes it very painful because you have to go and find a way to get into companies that don't need money.
Yeah. Signs of a maturing market and signs of good learnings from the past. So Mukesh, to you, sorry, Manish, I'm so sorry. Manish, to you, with late stage tech investments in India being traditionally dominated by foreign capital, it's good to see that multiples as a domestic fund has also entered this space. And you have also achieved very good exits in the recent past. So how is the firm looking at tech versus non-tech in the coming times?
Yeah. So at multiples, I think our focus sectors are four: financial services, pharma and healthcare, enterprise tech, and consumer. 95% of our deployment would have been in these four sectors. And if you see our journey, right from Fund 1, we have had a fair share of tech investments, tech-focused investments. In Fund 1, we did Delivery and India Energy Exchange. Both of them are now public companies. In Fund 2, we did People Strong, Quantify, and Dream 11, which has achieved tremendous success as well. And in Fund 3, we already have 4 tech investments. MoEngage, which is a customer-focused SaaS platform, Echo, which is a digital insurer, Licious, which is a consumer tech business, and we have invested in Neo, which is a customer-focused fintech platform. So we see tech playing increasing role in our portfolio construction across sectors, technology companies, be it fintech, consumer tech, health tech is the new area as well, and of course enterprise tech. And we believe that as we build our portfolio for future funds, the technology component across sectors will actually continue to rise, and that's just the nature of the beast. In fact, when we were starting our careers, I think India was known for IT services, and there was always this big thing that where are the products? If you see last 5-10 years, a lot of SaaS products out of India are really making global waves. It's still initial days, but I think next 10 years we will see really interesting businesses selling from India to global markets in that space coming up. And we believe that a lot of those would be very, very interesting investments to do as well. So yes, traditional sectors will continue to be very important, but I think the importance of tech across portfolio will continue to rise as we move towards successive funds.
Right. And Bhavi, we talked about your sector focus, and in general, certain sectors like financial services, healthcare, manufacturing even have seen a lot of investment coming in, despite the cycles, right? And then there are certain sectors like infrastructure, energy, green transition, which will continue to see a lot of focus because of the ESG mandate, as you mentioned, that many funds are focusing on, and even the government focus on sustainable development. So there has been a lot of fundraised by PE funds. A lot of global PE funds have also raised funds for India-focused investments. And so what are these sectors and these new opportunities that are drawing the attention of LPs, including IFC?
Sure. So, so from our perspective, of core sectors would still remain the same. I mean, that wouldn't change, but I would say that there would be a cross-cutting and an overlay of, as Manish mentioned, technology being one of it. So, technology and intersection of climate, ESG, that being, the cross-cutting across all the 4 sectors, right? So just to give you an example, I think the whole EV space is something across the 4 segments. We believe we can make a play, right? Because we need to do the financing for the EV segments, the 2-wheelers, 3-wheelers, 4-wheelers. The financing needs to happen. The manufacturing, the batteries need to be, there needs to be technology play plus innovation, because not necessary that, the technology that works in India, it needs to be different, right? Just the climate, the road aspects of it, there has to be an additional technology overlay for the EV sector itself. And in infrastructure, again, the wider infrastructure, the charging infrastructure needs to be. So for us, we can actually play across the segment, but keeping these two, technology and climate, being at the core, or maybe the foundations or the guardrails from their perspective. So that's one. I mean, other than that, I think, personally, I think the the agri-tech is one other segment which we believe, because we've been a very agri-focused fund, investment house as well, and we believe that the whole agri-tech is also something which is at its inflection point, and there would be a lot of opportunities there where we could play the development role. I think the good thing about, I don't know if it's good or bad, but I think from an IFC perspective, we don't have a fund life, right? We can invest for a much longer tenure, patient capital, because we don't have to return back the funds to our investors. So that makes it a little more easier for us to invest across various evolution of or stages of companies, whether it is VCs, growth capital, mature investments as well. So,
that's a good point, actually. So a lot of PE funds are interested in the ESG theme, but does it align well with the fund cycles? And you mentioned, the tenure is not an issue for a firm like IFC, but for many others, there might be some very focused funds that you have to create for aligning to the requirements of an ESG, I guess, impact area. I don't know if I should ask this question. Maybe Manish, you're looking away.
Either one.
My IR person has said not to comment on ESG with my perspectives. I'll have a different talk with the IFC lady afterwards.
Okay. Mukesh.
ESG, it can be done in an economic way also. Obviously, I think we are not just here to just, we have some responsibility to society as well. And a lot of our LPs also play a lot of importance on ESG. So when you go to raise capital, it's not just the returns we've delivered, but it's also the impact you create on the community. But at least across our portfolio, we have a dedicated ESG person. Globally, we have a team of 15 people whose only job is to make sure that from an ESG ranking point of view, we are much better from done the investment. At least some of the immediate measures which can be economically viable also, I'm sure Manish has done and is in industrial packaging companies as well, is moving to solar energy, which in fact provides 30 to 40% cost saving on what you pay on black energy. So there are various ways of looking at this aspect, and one has to get to it, and it can be done in an economical manner as well.
I'm going to step in for one sec because I can't let this end this way. I'll say Mukesh has been well trained by his IR guys for the discussion he had yesterday with his LP. But all I'd say on this topic is, on a serious note, if you genuinely do ESG right, there's a fantastic upside, okay? And I keep saying, and I was chatting about this earlier, in India, in order to get the G in ESG right, actually the best proxy is returns. If you get your governance wrong, your returns are going to be zero.
Exactly.
There's no question about it. The E and the S is slightly more complicated, and actually a lot of thinking, I don't want to be flippant about it. Actually, it does make sense if you totally internalize it. But I'll give you some random examples why our minds go crazy. I'm a huge supporter of EV. I've pushed many companies to go down the EV route, including a certain company in Pune. Let's go to California, which is the hotbed of EV. You should think that's a great thing. But let me ask you, I'm not putting you on the spot, but just to make it slightly more fun, is California has, let's say, 40% of its cars as electric vehicles. Is that a good thing or a bad thing?
Sorry, 40% of the car?
Let's assume 40%. It could be 30, it could be 70, I have no idea.
I think it depends on what the grid is being...
So what do you think the California grid is based on? 80% of the grid is coal.
Yeah.
Okay, people don't realize that. So the underlying grid is coal. So we're talking about cars moving to EV, the underlying aspect. So I'm just saying it's a very complicated... Anjana, one second, I'm just saying it's a very complicated subject, and I don't want to give a flippant answer, and I'm just saying you need to get to like the secondary, tertiary derivatives to really understand it. And unfortunately, we've gotten to this certain mode right now where there's almost like an authority which stamps an ESG tappa. Like, we used to have the McKinsey tappa with a lot of the larger corporates in the country. And I mean, seriously, I think, truly believe into what Mukesh said, and I didn't mean to pick on him. It's a phenomenal outcome, and I think, but you need to internalize that. Absolutely. And the aspect is great.
And also, Manish, I'll also add, at least it's no longer ESG is, not just from our point of view. We have a lot of controlling stake in industrial companies, and where most of our companies are export-led, where actually our customers are asking on the ESG front, where are you guys? Because they pick you as a supplier if you are ESG compliant. We're talking about tubes which have to be recyclable. We're talking about when you're transporting, goods from here, what's your carbon effect? So, these issues are for real. They have to be taken seriously. As I said, these issues will become more and more real as because of the climate changes.
Yeah, I suppose the takeaway is that responsible investing and development goals and unit economics can all be achieved together.
Yes.
That is the goal. But it starts with the right intentionality, which I think our PE funds are all right there now with, with their sustainability goals in mind as well. I've been told that we are running short on time, so if we have any audience questions, we can quickly take those. Can somebody pass a mic to them?
We are open for the Q&A.
Hi, my name's Rajiv. I run Seed Stage Venture Capital Fund. We're investing from our second fund, which is a 300 crore fund, focused on B2B and enterprise tech. So I was with one of my portfolio companies last week, and he's fintech enterprise services combination. So he said, one of the things he's asking me is, given all the noise that RBI makes, so one of the things he said is, there's a lot of inbound interest for potential Series B. They raised a 15 million Series A mid of last year. So with all the noise that RBI makes, one of the things he asked me was, boss, all the funds are overseas funds. I want to raise money from India AIF so that aage jaake complications nahi hoga. Hearing all of you saying very long on India, I don't know where each of your structures are, but I'm guessing a lot of your structures, excepting maybe multiples, are outside India. How much of an imperative is that? Is that a serious consideration amongst all of you? While if you don't have it, it will come. How much is it being pushed, or how much are you folks doing it organically or willingly and stuff like that? Setting up India structures.
I didn't get the question. I also didn't.
So just to repeat, your question is, how much of a push are you getting from regulators about setting up India structures?
Yeah, how much is it necessary to continue doing business, or can you continue just being offshore structures, taking an offshore capital?
How much can you use your offshore vehicles, and how much is there a push to bring it to India with India structures? Any experience?
Answer for us is very
I felt
simple
like any
because
question that we got that none of us were sure who should answer, we'd just point to him. That was the agreement on the panel at the beginning.
I think for us, the answer is very simple. We invest out of Asia fund. So we'll have an offshore structure because LPs are not just taking exposure to India. They're taking across the Asia. So with global funds, with having not an India dedicated fund, it will always remain offshore fund.
Yeah, same for us.
Yeah, and we've always been AIF, so we don't know anything else. We don't know what these guys do in Mauritius or whatever else. We're simply AIFs here.
I think just to add, at least as an advisor, what I've seen, the regulators are asking for transparency, right? But as long as they get the transparency of where the money is coming from, what the purposes are, they are quite sophisticated now, or at least getting there, on global structures being followed for Indian investments as well. Any other questions?
Great panel discussion, great insights. Just wanted to check that as a private equity players, and looking at the aviation space, we've been reading headlines, the largest Boeing Airbus deal. I was flying from Delhi, the flights are always full. How do you guys look at this sector? Have you actually invested in this? Do you look at this as an opportune area? Time travel might not happen for a while, so what's your take on that?
I might, because my most recent investment is in travel sector, so I'll take that. We directly don't invest in, we have not invested in airlines. The only investment we did was Trans-Maldivian Airways, where we used to own the seaplanes of Maldives, where we had a 80% market share. But what we are really playing is the derivative. We just recently invested and took control of a company called EFS, which is a play on, the growth from, the emerging market to developed market. And what we are seeing is really insane amount of growth. And the factor which is driving it is not just the COVID revenge travel, the way the world is actually working now, with a lot of IT and BPO employees working 3 days a week. It gives a lot of time for them to travel, to explore the world, which is really, I think it's not just a short-term phenomena. The way, what COVID has taught is the different way of working, and travel will be a long-term growth story. Aviation is a very capital-intensive business, but derivatives of that, which is VFS, and are one of the largest tech companies in India. Many people know software as a service. We own a company called IBS Software, is again a play on the travel sector. So that's how we are playing the aviation sector.
Just to build on that, from our vantage point as well, as we look at consumer behavior and look at the Gen Zs and millennials as they're spending, experience over things is obviously a very important phenomena. So travel obviously plays a huge role. So there's the COVID bounce back and revenge travel, but travel experiences, events are all quite core for this group as what they spend on. And they also believe a lot in living in the moment, so they're not postponing a lot of these expenses. So travel is obviously a beneficiary, but again, we look at derivative businesses in the consumer space that will get created as a result of that.
I mean, there are many investors who say you start off with $1 billion and you put some money, and you've heard that, so we won't talk. But I'm just saying, in addition to this, in India, the other two huge opportunities is actually in tech services. So if you see the amount of actual offshore development that OD and software services is specifically for the large, and then the BPO side to it, which is another large one. We look at WNS and the others. And then fundamentally, the whole area of MROs. So, that's the other area where people have got. But I think we should end this at Upasana has Mukesh's mobile number. If you want a visa, don't apply to your travel agent. Mukesh is the guy to go to. He'll get it to you the next day.
I think that was a mistake of mentioning VFS.
The cat is out now.
I think that'll be the last question. One last question. Take that question.
Funny man.
Yeah, hi. Thanks a lot for this enthralling session. One question for you. Now that the market's valuations have come down significantly, especially in the startup unicorns and all those things have come down, what is your view that you guys are from the private equity side? So would you be taking interest in acquiring some of those, the unicorns may not mean like 50% off, 40% off. We are hearing all kind of rumors that many of the unicorns may not survive more than 6 months because the cash is burning out. So what is your view on, as a panel, because you guys are the private equity guys, you are the guys with the big checks.
Are you going to end the funding winter, as they call it?
I would say that the winter is not as cold in India. It's a little warmer because we still have a market with slightly stronger fundamentals than most others. I would say that, I alluded to this earlier, there are some companies who actually tanked up on capital and probably are safe. They probably can't justify their last round valuations based on current market multiples, but they have bought themselves time. The ones that are in the market today are probably the ones which are running out of capital, and as a result need to deal with the revised market multiples that typically we've used as comps, right, for most of them. So if you ask the question saying, will private equity invest in these? I think we will have to take an assessment on all the things we would usually do, saying, Are the founders good? Is the team good? Has the business model now made sense? Is there a price at which both parties can get comfortable? So I wouldn't say it's a clear yes or no. And I would also say that in the last 6 months, because of this environment, a lot of companies have actually done a very good job of meaningfully improving their economics. So those would be some of the things that folks like us would look for to start considering them seriously and figure out whether it makes sense either as a direct investment or to roll up into an existing asset.
All right, so with that, we are going to move into a very short networking break. But before that, I would like all of you all to please give a huge round of applause to all of our panelists present over here for all the insights that they've shared with us. To all of you all, I request you all to please come forward for a photo op. And also, small request, you can keep your labels at the table and then we can go ahead for the photo op.
I'd also like to thank all the panelists for
you can use this. Ladies and gentlemen, one more time, a huge round of applause for all the experts from the third panel. And we're going to take a very short networking break. So all the questions that I did not let you ask, this is the time to go ahead and communicate all of them. We're going to be back very shortly at exactly 3:30 with the final panel discussion of this evening. So make sure that all of you all are something very, very important, which is exits and liquidity. So we're going to start sharply at 3:30. Make sure that all of you all are present over here. Thank you so much.